Hi, everyone. Welcome to Accountable, the podcast for your business and for all of you practitioners out there. I have to tell you that it is a magical, a special time of the year. We are finally here. It's time for tax season. I distinctly remember that when I was an intern, I had my internship at a small CPA firm that was just north of Chicago. And I remember asking the owner of that business. I remember asking him. I said, "Do you love or do you hate tax season?" And he said, "Yes." He said, "It's the time when I make my most money," but he said it's also the time that I'm most busy and that I have the most pressure as being a CPA. And so I would imagine that probably some of you have a love-hate relationship with tax season. I think I probably fall in that category. I'm sure that probably a lot of you do as well. Hey, we're here, and this is what we do. If you're a tax practitioner, this is what we do here as CPAs. Even if you're not a tax practitioner, if you're listening to this podcast, a lot of times, if you're a CFO or you're a financial advisor or you're really in any way sort of involved in the financial world. I mean, tax season is just a lot. It's a lot to get together. It's a lot of stuff that we need to keep in mind, and it's a constantly changing animal. I think that is fair to say. So we're going to be talking about some of the things that are going on with tax season this year. It's a little bit of a different tax year. We've had the last couple of years where we've had lots of new legislation. In 2022, right at the very end of the year, we snuck in Secure 2. We also had the Inflation Reduction Act a little bit earlier than that. And we've had a lot of legislation, a lot of big bills that have gone through kind of in recent years. 2023, not as much, but that doesn't mean that there's not a lot going on. And so we're going to discuss all things tax season here, and we have a great guest. Here with me today is Bill Harden. Bill is an associate professor in the Bryan School of Business and Economics at the University of North Carolina at Greensboro, where he teaches tax courses on flow-through entities, individual tax, also does some corporate tax as well. He has over 30 years of experience in taxation. He began his public accounting career in 1990 in Dallas with one of the big six accounting firms. He does a lot of work with tax and financial planning issues for small businesses and individuals. He's one of my favorite folks to tag team with to get the pleasure of tag teaming with Bill on the Don Farmer tax seminars and also with some of the things that we've done with the AICPA. And so it is a pleasure to welcome to the show Bill Harden. Bill, thanks for being on Accountable.
Thanks a lot, Dave. I really appreciate it. And again, it's great to do this with you. As you mentioned, we've done a lot of work together, team teaching things in the past. I actually think, especially on those multi-day classes, that's it's a good help. Give the participants a different sort of a viewpoint than we can do otherwise. I hope you don't mind. I'm going to piggyback on one thing you mentioned at the beginning when you were talking about the love-hate relationship with busy season. Some of my students at the university, I think, may think I'm funny because I don't give the standard answer sometimes with when they're having that issue of where they want to take the job, and I tell them, look, said pick a place where you like the people and you will fit in because you're going to spend a lot of time with them. You're going to spend a lot of time with them. It's funny. I had a student who went with the firm, particularly because of reputation, but she was married and had, family stuff going on, and all the other staff people were single and wanted to go out and do the night kind of thing after work. And she didn't last very long there because it was just not a good fit. And that's one thing. And it's I feel like that's good advice. So it's definitely one of those things where you've got to think about what you're getting into. Yeah.
I'm glad that you said that because I have to tell you, I think especially in my own sort of recruiting life, I've had the pleasure of working for startups for most of my career, as you know. And so I've hired a lot of people. And so it's all about fit. And I think especially for CPAs, that are coming into this, tax season, I can tell you it's tough, especially those first couple, I think that those are really tough. And you're right. You're spending all this time with these same people. You
Hmm.
got to get along. I would also say though, too, it was probably where I learned the most as kind of an up and coming CPA is that, this is such a learning profession. I mean, you learn by doing, I think, a lot of times in this profession more than anything else.
Oh, absolutely. It's funny. I had a friend of mine who's an attorney in Dallas, where I started working. He said this is something that accountants and attorneys both share. Is that it's interesting. A lot of times, the people who do best in school in accounting and best in like law school, both don't actually turn out to be that good at being CPAs or at being attorneys,
Right.
because with what we do, it's you just have to sit down and do the work.
Yep.
And a lot of times, where stuff comes easy to people, where they just are book smart and can go in, read a
Yeah.
book, pass tests, then it turns out, you guys are counting, you got to really do the work. You just got to sit there and grind it out. And
Yeah.
that can be tough for them sometimes. Yeah, absolutely.
I think you're right. Speaking of grinding it out,
Mhm.
we're right on the cusp of tax season here.
Yeah.
I mean, we're getting ready to jump in, kind of with both feet. Um, eh, so I mean, I've heard it said by some people that this is a light tax year. 2023 is a light tax year. What would you say to that? Would you agree with that? Or are you kind of more like me where it's like, yeah, okay, maybe it's still light, but that doesn't mean that there's nothing going on.
Yeah, I actually would agree with you a lot on that, Dave. There weren't really any, like you said, significant law changes this year. But, for me, there's a lot more little nuancy kind of
Yeah,
stuff that we have to keep up with.
yeah,
And this actually, to me, is tougher. As I get older, I find my memory doesn't work as well. And, I'm having to think about, what do I need to ask in the organizers, for example, with respect to the energy credits and things like that, because
right.
there are a ton of them now, right? You
Yes.
mentioned the Inflation Reduction Act made a lot of energy credits. I certainly can't keep all that stuff straight in my mind. And so I have, lists of these things that I have to do. So again, I think there's a lot to keep up with in terms of the regulatory guidance and watching for the IRS to put out
Yep.
their guidance. And as they didn't put out the regulations again this year
Yeah.
regarding that RMD stuff. And
Yeah.
I've had a couple people actually who have contacted me saying, hey, do we got this account we inherited after
Mhm.
2020. The person had already been
Yep.
who died had already been past the RMD age. Do we have to, or I guess required beginning date? I'm sorry, I
Right.
throw a
Yeah.
term
Yeah.
there,
Yeah. No, I
but
gotcha.
they were asking, do we have to take an RMD? And I'm like, no. I mean, the IRS has still said they're forgiving that through 2023, and there's not going to be a penalty for it. But then the questions come up a few times. People say, well, okay, so then that means our 10 years doesn't start, right? I'm saying, no, 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 no. Your 10
Yeah.
years is already
Right.
going.
Right.
I said, you've
Yep.
got to manage this
Yep.
because you've got this 10-year window from when you inherited that account, and the fact that they haven't made you take RMDs for the first 3 years of this doesn't mean that you get an extra 3 years on the end. You've got to get it done in 10. And if you
Yeah.
don't want an explosion in your income, that means you've got to think about getting that money out.
Bingo. Bingo. I am very glad you said that. I actually think that that's actually one of the more notable challenges this year is you do have a lot of kind of nuancey kind of stuff. Secure 2, I think is particularly challenging. I mean, you mentioned the Inflation Reduction Act. I
Mhm.
think that we have to make big time changes to our organizer this year, making sure that we're
Oh
getting all
yeah.
the information. I think more than we have actually probably had to do in the last few years. Um, Secure 2 is also an issue too because we have effective dates that are all over the place. I mean, with like, at least with the Inflation Reduction Act, it was pretty much kind of everything kind of was effective at the same time. Not true with Secure 2.
Absolutely. Yeah. And yeah, it's, that's one of the things, you mentioned that, us doing some CPE teaching this year with Don. And,
Yeah,
it was nice that he laid out all his material by year of implementation.
right.
And that really helps, a lot. And, for example, this year, one of the things that we're going to have to think about is, if you've got somebody who's got that solo 401k, for example,
Yeah,
remember, the Secure One had said, you could start that thing after, they changed it so you could create those plans after the end of the year, just like you can with a SEP. We've always been able
Yep.
to do that with a SEP.
Right.
But, for proprietors, they added that new rule now where you can actually do the elective deferral
Yeah.
up to the unextended due date, not the extended due date, but the
Right.
unextended due date on that elective deferral. But again, that's something that's new, that's come in this year. One of the others, somebody was asking me about that. I'm trying to remember, we were talking about it, was the doing the Roth, having your, the employer side match, I think being Roth, for example,
Correct.
and things like that. We haven't been able to do that in the past before this
Yep.
year, and there's still a lot of confusion out there about that. But that had already kicked in, and
Yep.
but a lot of other things, they're delaying, like that. The one of the negative ones that we saw, that for people who are making over 145,000 of, I think it's FICA wages or Medicare
FICA
wages.
wages. That's
Yeah.
correct. Yep.
If they're over 145,000, it was supposed to be 2024
Yep.
where their catch-up contributions were going to have to be Roth, but they ended up delaying it for 2 years.
Yes.
So
Yes.
yeah, it's just all over the place, and I have to keep notes to myself because I can't. My memory
Yeah.
just won't do all this stuff anymore.
Yeah. Well, and I think that I think for a lot of folks, I think that that is really the challenge. So I want to go back to kind of something that you said. We talked
Sure.
about kind of the notable challenges for 2000 for this upcoming year, for the 2023 tax year that we're working on for 2024. We talked about changes to the input sheet, to the client input sheet. Um, and we talked about green energy credits. I think that some folks are still kind of struggling with what they need to actually get from the client, because they're starting to see people that actually do have vehicles that are kind of qualify for things like the new clean vehicle credit, and
Yeah.
and things like that. So what all do they need to get? How would they need to modify maybe their input sheet to accommodate something like the clean vehicle credit?
Yeah, I think there are probably two broad categories that we want to look at. One of those is the vehicles, and one of those is the home improvements.
Yes. Yeah.
And
Good point.
so, you would need those. Now, the dealers are supposed to be providing all the information needed to be able to claim that vehicle credit.
Yep.
Although luckily the IRS has actually put out a website, and
Yeah.
they, people can go to the IRS's, website ahead of time and check and see whether the vehicle is going to qualify, because it's just crazy. The new vehicle credit is, it's got two parts to it now,
Yep.
based on where, the components come from and where the battery's assembled and all this stuff, as well as that, North American assembly requirement. And
Yeah.
so there are a lot of details. And so when you go to the IRS's website, you can find out if the vehicle is going to qualify for 7,500, 3,750, what it's going to do. And so you can actually go there and come armed with that to the dealer, hopefully beforehand. But for us, on the compliance side, what we're going to have to be doing is, I'm certainly going to be asking everybody, did you get a new vehicle this year?
Yes.
And
Yep.
then if they did, follow up with what type of
Yep.
vehicle.
Yep.
And so again, want to make sure that they have that information, and it does, and you don't want it to just be information if it's a new vehicle. If it's a used vehicle, you
Correct.
need that information as well. So you want to basically find out, did you get any kind of new vehicle that's either electric or hybrid or fuel cell?
Yeah.
And if any of
Right.
those kinds of things, we need that information so that we can go in and try to figure out what kind of a credit that they're going to be able to get for that. And the used vehicle credit is there now as well. And
Yeah.
there are a lot of nuances with these things. Dollar
Sure
limits on
is.
the cost of the vehicle.
Yep.
The income limits on the taxpayer. They need to be
Correct.
under an income limit either this year or last year. And of course, they'll
Yep.
know if they were under last year or not, but this year they may not know until
Yeah.
after we do the work for them. So yeah, it's a lot of stuff to keep up with, and it's just better to say, hey, did you get a new vehicle this year, and if so, what kind, and did you get any
Yeah.
information on this, and get that to come in.
Yeah, so I mean, so folks, if you're worried about those vehicle credits, I mean, I mean, they're supposed to, your clients are supposed to get that input sheet. Now, if you're like, we all work with clients, right? Okay, so somebody could get the thing from the dealership and kind of toss it over the shoulder, and forget about it. But you still got to back up here, and I do think that
Mhm.
that's Bill makes a good point there. Fueleconomy.gov, I believe, is the name of the website, where I believe that you can go, where if you put in the VIN number into the vehicle, you can figure out some of the requirements there, and you can get the stuff that you need in order to actually take advantage of that credit. So you got to back up, but you do need to get the VIN number. That's the important part. Get the VIN number so that you can take that credit, and you can look it up in case the client doesn't give you everything you need.
Yeah, I can't remember if you can get in by VIN number. I've only tried make and model
Okay.
on the website. But yes, you're exactly right. If you're going to have that VIN number to claim the credit on the
Yep.
tax return. And of course, we'll obviously have that if you've bought the vehicle because it's right there on the
Yeah.
vehicle.
Right.
But that's
Right.
going to be a key piece of information. And then, if they've lost a piece of paperwork, they should be able to get that back from the dealer as well. Yeah, that's a
Yeah.
great point.
Yeah, and I think that that's one of kind of the nuance, kind of a things that that I think is going to be coming up. There's a ton of green energy credits out there. We also mentioned the green energy credits for housing, and some of the things there. There's I think you have a much more lucrative credit than you did. It used to be
Oh
that
yeah.
that we used to have a $500 one-time credit. Client would walk into your office, they'd be all happy, they'd say, hey, I put energy
Yeah.
efficient windows on my house, I know I get a credit, how much is it? $500. Well, what if I do it again next year? No, you get it $500 one time.
Yeah.
Now $1,200 a year,
Yeah.
plus the opportunity that there's a certain category where it's an additional 2,000 on top of that.
Yes.
So much more lucrative of a credit now. Do you think that we're going to start to see maybe more people try to take advantage of that now because the credit's a little bit higher?
Yeah, I would certainly hope so because a lot of our clients make these improvements to their houses, each
Yeah.
year that have whatever the required Energy Star rating is. Again, I apologize, my memory, I don't remember if it's a
Yeah, yeah, yeah.
3.2 or 3 or
Yeah,
whatever it is.
right.
But yeah, a lot of clients do that. And the thing is, we've trained a lot of them because, I said a decade ago, they did improvements, got their $500 credit, and then they've learned from us. You don't need to give
Yeah.
us any more information because we can't take any more credits. And now
Yeah.
we've got to get them back in the habit of, hey, every year now, give us this information. You've got this potentially $1,200 credit now. And as you said, for certain types of property, it even can be bigger than that by that additional 2,000. That's one that I think a lot of us had not expected. I thought that while the law had that 2,000 provision, I thought that would mean, okay, that means you could take your 1,200 up by 800 more if you buy that.
Right.
But the
Right.
IRS's examples allow people as much as a $3,200 credit, and so
Yeah.
that's huge. That is
Well,
huge.
well, and that was a big clarification, I think, and I think that
Oh
that's
yeah.
a good example of some of the things that we've seen in the past year, where it's like we have the rule, but we really didn't know how to apply it,
Yeah.
and I think in the example that you gave, I think was a good one. I assumed the same thing, that it was going to be 2,000. You had this group where the sublimit on that group of expenditures
Mhm.
was 2,000. And I thought like you that it was just going to be an extra $800, but the IRS examples have
Mhm.
said no, it's actually 2,000 on top of your 1,200, and
Yeah.
so that's a very it's a much more lucrative credit. But I think that those nuancy kind of things, those that I think is very characteristic of this of this legislative year, I should
Yeah.
say. Is that we're getting some clarification on some of the things that have been passed in at least the last two or three major bills.
Yes, I would agree. And we're going to see that again probably during 2024.
Right.
Yeah, I mean, I don't want to get into to the political debate, on either side or anything like that, but you know how it is. They don't
Yeah.
tend to do a whole lot in these years leading up to the elections. And so it'll be interesting to see if we get some legislation this year, with respect to that. And they are talking about some things. I think you mentioned, earlier they were when you and I were talking, they had talked about what is it, giving us back the research expenditures
Yeah.
as
Yeah.
the Jobs Act made that 5-year amortization, and now they're talking about immediate expensing again. They're talking about bringing
Yep.
back bonus depreciation again. Be really interesting to see if they do that and at what level
Yeah.
they
Yeah.
would do it. And I'll be honest, even just 3 or 4 months ago, I was not expecting those to come through given the budget, the budget situation. But it's interesting. Those have come back up. So who knows? I could be totally wrong.
Yep.
2024 could be a
Yep.
big legislative year,
Yeah.
but I'm expecting it to be much more along the lines of a lot more guidance with respect to these kind of nuancy provisions that we've gotten.
Well, and I think that you're saying something though that I mean that has proven historically to be true. No matter who's in office or who's kind of taking office, election years tend to be years that where we do see some activity. It is interesting to see where at least the early part of the year has gone. The
Mhm.
174 expenses, the research and experimental expenditures, in addition to those software development costs that are included in there. We had a waiting period before we got regulations on that, and that in a lot of ways I think kind of screwed everybody up,
Yeah,
honestly.
yeah,
And so so now we're thinking about going back. And it's interesting too. We've really gotten used to the other one that you mentioned there is bonus depreciation. We've really gotten used to 100% bonus depreciation.
yeah.
These this year I found myself going back to my university teaching past where where I've started talking about depreciation ordering rules 179 first, bonus
Yeah.
depreciation second, and makers last, because I'm not sure that you really care about that stuff if you're if it's 100% bonus. But being at 80% bonus, I think I've had a few practitioners that have said to me,
Yeah.
I haven't done this in a few years, and talk to me about this.
Yeah, I mean, this year it's not such a big deal with it only being again 20% that's going to be there that would, for example, potentially get thrown onto mid-quarter
Yeah.
convention, after taking the
Yeah.
bonus. But if it drops again to 60% next year and then down to 40%, you're getting bigger pieces of remaining depreciation that you're going to care a lot about whether you're on half year or mid-quarter. And so, yeah, those rules of, remembering your 179 for the longer lived things, remembering 179 for the fourth quarter assets start coming into play, again, and you have to pay attention to that. And yeah,
Yeah.
so we've gotten spoiled since 2018 with it being the
Right.
100%. You just take it. Yeah.
Right. Right.
Well,
And
except for
I
state purposes, then you get all these state goofiness, which
yeah.
you understand why, because they got to balance their budgets.
Right.
But yeah, it's crazy.
Yeah. North Carolina, Virginia, we're talking to you on that state craziness there. So
Oh, it's totally
yeah.
logical to add 85% back and take it ratably over 5 years. I mean, come on, who
Yeah.
wouldn't think who
Yeah.
wouldn't think that was
Who
logical,
who wouldn't think that? Yeah. No, you're right. You're right.
Yeah.
Let me ask you about something else that we also kind of talked about briefly, but I want to circle back because this has really been the issue because I'm a financial advisor. I know that you have done some work with clients in financial planning areas and that kind of stuff too.
Yeah.
RMDs continue to be like this big amorphous thing that we still don't have a whole lot of clarity on. And I think people are really struggling, especially with those inherited
Oh yeah.
IRAs, on what to do with RMDs, because I think that there's a lot of practitioners out there right now. You can correct me if you think I'm wrong here. I think there's a lot of practitioners out there right now that saw IRS Notice 2022-53 and IRS Notice 2023-54. And like you said, they don't think that that 10-year window has started yet for those RMDs. And so all they're kind of doing is they're not doing anything with the client, and the client's balance, is building up in the account, and they might be kind of setting them up for a fall there.
Absolutely. And especially, I mean, you didn't worry about it so much, I guess a little more than a year ago when the market was down, quite a bit.
Yeah,
But now this has been a good recovery year for a lot of people.
yeah, yeah,
And so depending on what that thing is vested in, or invested in, you may have a much bigger amount that's in there. But yeah, there's no question. I mean, one thing we this is a tax research. You start with the law And what
Right.
matters is what the law says. And then, yeah, the IRS interprets that and gives other guidance and things. And like the exact amount of RMDs in this year to year stuff, we're waiting on the IRS to get us. And the controversy, really came about because on these inherited IRAs, where the person who passed away was already taking it,
Yep.
do you just have to get out within 10 years, or do you still have to continue working one of these life expectancy kind of calculations? And the IRS said, yes, you do. And a lot of
Yep.
people in practice thought, oh, no, no, that's not what Congress intended, because when you read the committee reports, so just got to be out within 10 years. But
Yep.
back to your point, there's no question. The law is absolutely clear. If you are
Yep.
not one of those things like a minor child or a surviving spouse, you
Yep.
have to get that money out within 10 years. That's the law.
Yep.
The IRS
Yeah.
doesn't have the ability, I don't think, to waive that because, again, it's a strict statutory requirement.
Yeah. Yeah.
And so, the amount that's in there, like you said, is it's just a matter of, do we have to keep taking it along? Now, I'll be honest, when people talk to me, and this is absolutely not something I would recommend as formal,
Right.
tax advice on how to treat something.
Yeah. Yeah.
But I had, when people talk to me, I said, okay, let's be practical. What did the financial institution put on the 1099?
Yep.
What are they telling you?
Mhm.
Should have been taken out, is taken out. What's going to be documented? Find out what they think, because they'll do the RMD calculation for you for the account, what they think it needs
Yep.
to be. Find out if they think there needs to be one.
Yeah.
And then the other thing that I think is very practical about is look at how much is in that account,
Yep.
and then see, okay, look, we've got 6 years left to get it out.
Yep.
Do we really want to not be taking RMDs now, right? Because of this time window that we've got. Because yeah, that 10 years is a hard and fast. That's in the statute. That's in the law. Unless they
Yeah.
change the law, I don't see how you get around that.
I don't think that you really do either. I also think too that, sometimes I think, maybe we worry a little bit about too much about what you can do and maybe not as much about, kind of the tax, you know, kind of just kind of obvious tax planning implications. I distinctly remember, my mother saying to me when I was a kid, just because you can do something doesn't mean that you necessarily should.
Yep.
And I think that that applies here. There's nothing wrong with taking more than the RMD. And if you
Correct.
have an inherited account and you need money, like I actually had a client who, she had inherited an IRA.
Hmm.
She lost her job. And so she was kind of in an artificially low tax year anyway. And so I said, well, there's nothing saying that we can't start pulling from the inherited IRA. We have to get it all out in 10 years. I said, why don't we, even if we're not required to, maybe we should start, because I was like, you need the money anyway.
Yep. That's a great point. And I think you and I talked about doing this in, with our clients in terms of the financial planning and the tax planning
Yeah.
is, when you've got years when your income is down, like let's say this year you got somebody who's down in the 12% bracket instead of
Right.
24 or whatever.
Right.
Those are the years you need to manage these things. Take out more while
Yeah.
you can in that lower bracket. And the same thing with Roth conversions, right? This
Yeah.
is when you think
Right.
about, okay, let's go ahead and make it taxable, convert to a Roth. Because, again, you want to take advantage of those things when they're available. Now, obviously, that means we talk to the client not in January or February, but we talk to them in November or December, right, to get
Right.
them aware of that. But yeah, that's really important, is to manage that, because you don't want it all coming out like, this huge, lump sum later. And again, you have to think about which assets, let's assume you got the same stocks in both the retirement account and in your investment
Hmm.
portfolio. Well, are you going to get advantage of the dividend rates? Is it something, or I should say the long-term capital gain rates? Is it something
Yeah.
we're going to be able to get at 0%?
Yeah. Right.
That changes that answer too, right? In
Yeah.
terms of what we want to do. And so there's no one size fits all. You just got to sit down and look at the client's numbers and
Yeah.
figure out, what the best sort of option is there, tax wise. Now, obviously, you don't want the tax tail to wag the economic dog. So if the investments that are in the two things are not the same, you don't want to just look at the tax outcome. So I have to
Yeah.
say, assuming you got the same investments in both,
Yeah.
then which do you want to do? But yeah.
I think that's an excellent point. Don't forget about kind of the Roth versus traditional impact, and and that as well. I think also too, the other important piece that I see is that you may have some folks that may still be, harvesting losses out of the, portfolios as well. The equity markets have been
Hmm.
rough. And so, there may be an opportunity to, harvest some losses and pull some money out of the inherited retirement accounts, at the same time and possibly offset those at least to a degree. Not quite one and the same, right? Because we're talking about capital
Yeah.
losses versus ordinary income, but there might be some opportunities there. Also, I think timing matters too in terms of when you
Hmm.
actually pull the money out, because
Yeah.
at least in theory, and the last couple of years in the equity markets, Bill, have put this theory to the test. But in theory, markets go up over time. Okay, again, the equity markets may not have maybe not been as cooperative, as all the time they're here recently, but. I mean, so if you want to take that appreciation out of that account, there's nothing saying that you can't take that RMD very early in the year as opposed to
Right.
waiting all the way until December. And so, so there is some logic in that as well.
Yes, I would agree with you on that. I mean, yeah, it's, again, you've got to look at the overall economics of what you think is happening there. And yeah, equity markets are funny. I'll be honest with you. If you talked to me 20 years ago, I had the
Yeah.
trading account and I tried to play around with it, and I learned, no, just long term buy
Yeah.
and hold, and
Yeah.
of course some people say, you can be more sophisticated than that. But if you look at any of these things, if your time window is more than 10 years,
Yeah.
it is incredibly rare for anyone who doesn't have inside information to beat the market.
Yeah.
It just, and especially if you take your window out to 20 or 30 years,
Yeah.
it just doesn't happen, and so, you can invest in sort of the broad market or the S&P 500. And again, I should be careful here. Don't take anything I say today as investment advice. Okay. I have to be
Yeah.
careful. And that's one thing, I do when I talk to people, I do holistic kind of financial planning, talk
Yeah.
about how do we get our budget in order and things like that. Not, I don't pick stocks or investment. I'm not insured
Yeah.
for it. And so
Yeah.
I don't. So hopefully none of your
Yeah.
listeners will take anything I say today as specific investment advice, because
Yeah.
I don't do that.
Well,
I was notoriously bad about it. My dad, on
yeah.
the other hand, is really good.
Yeah.
But I'm not.
Yeah.
He does pretty well with those things, but again, I can't do that. So
Yeah, no specific investment advice from either one of us here. Here we're
yeah.
just two tax guys talking here today. But I can tell you though, what is interesting. I don't know if you've ever read the book A Random Walk Down Wall Street. If you remember that
I have not
book.
read that one. I know
Yeah,
it's how I have not read that one.
yeah. So anyway,
Um,
so that's a good read too, where he basically describes the markets in terms of a drunk gentleman,
mhm.
and so
Yeah.
it's that the random walk. So
Yeah.
anyway, for those of you that haven't read Random Walk Down Wall Street, it's a good read. So
Yeah.
let's get back to where we're supposed to be in the
Sure.
tax world, the place where we're supposed to be. One of the things that I think has been particularly difficult, I think, because we were kind of talking about kind of the investing world and some of the things that are going on in it. I think from a tax side, virtual currency continues to be just a beast, just
Yep.
because of the lack of regulation, lack of transparency, lack of, just organization in some cases.
Yeah.
Um, are things getting better, or are we still kind of in the same boat we've been in?
To me, it feels like we're still kind of in the same boat. I mean, it was probably a decade ago that the IRS said, that virtual currencies are property.
Yeah,
And that means, you track basis in them and, have gains and losses when you dispose of them. And if you're, paid for doing work in it, it's still ordinary income. That becomes your basis. They put out those rules. I think it was back in 2014 or something like that. It's been a while.
that's correct.
Um,
Yep.
yeah. And little pieces get tweaked, like the one a few years ago where they said, okay, the digital assets are going to be cash, for purposes of Form 8300.
Yeah. Right.
And that is so okay. So in one way it looks like property, but now you're saying it's cash for this purpose, but it's not changing the overall character.
Yeah.
And
Yeah.
when we were teaching the update this year, we had an IRS piece of guidance that was out there that talked about for the 8283 form, the non-cash contribution form, you've
Yes.
got to have an appraisal of virtual currency, because
Yes.
even though it's traded and
Yes.
but it's not a
Yes.
security.
Yeah.
It's not
Yeah.
considered it's weird, because it has to me, it has the flavor of like a foreign currency. And I think that's kind of the closest thing in terms of how the IRS is having it taxed. It's like a foreign currency, and you can have exchange gains and losses, that kind of thing. It feels like that, but in some ways they treat it just like, even non-currency property. In some ways they treat it,
Yeah.
like cash. It's crazy.
Yeah.
And so but I think it's very interesting that they're wanting it as cash for purposes of the Form 8300, or at least they will whenever they implement that. But they don't seem to treat it that way with respect to the charitable contributions. And it's like,
Yeah. Yeah.
it would be nice if there was a little more consistency there. Yeah.
Well, and you bring up the Form 8283, and just so folks kind of know what we're talking about there. One of the things that, if you remember, right, if I take a charitable donation deduction, if I take a charitable contribution deduction for property that I give to a charity that's up over $5,000, there's an appraisal requirement. That's that part on Form 8283. I don't have to attach the appraisal until we get up to $500,000, but I have to get a qualified appraiser to sign off. And to I guess a little bit of a surprise, we had a CCA come out this past year that basically said that with virtual currency is property, which is has been largely been the IRS's stance, and so therefore it requires an appraisal. Even though, we have, we do see prices for virtual currency every day. The regulation, it's not necessarily on a regulated market, but it is, we do see prices. And so, the question was even asked in the same CCA. They said, hey, so can we just point to, the market price, like we do with publicly traded securities, and that kind of waives the appraisal requirement? And the IRS says no.
Exactly. That's
Yeah,
exactly right, Dave. Yeah, they're not treating it as a security, even though
yeah,
it appears on exchanges. It's
yeah,
not technically a quote security
right.
in the way the IRS views a security. And so, yeah, they want that appraisal on there with respect to that. So,
Well,
which,
and
all the appraisal is going to do is look at the
yeah, right,
at the
right.
exchange and
Well,
use that. But technically, you got to go through that hoop. It seems. But again, it is just a CCA, as you note. It's not at the level of a regulation or something, but still,
right.
it's yeah.
Well, and also I think too, just the logistics of that could be problematic too. You know what I mean? Because again, you got to find a qualified appraiser, to do that, and
Yep.
so there may be some logistical difficulties there. I think, and that could
Correct.
come up, I think, in certain instances as well, where maybe you have trouble
Yeah.
finding a qualified appraiser. So I guess what I'm
Yes.
saying here, folks, is that if you got a client that is thinking about giving virtual currency to a charity, my first question is always, does the charity want it? But if they do, that's something to think about. If we take that deduction up over $5,000, uh, we may have an
Yeah.
issue there.
Yep. Absolutely.
That might be tough to get around.
Yep.
So.
I would agree with you fully on that. Yeah.
Let's talk about something else, though, with virtual currency, which has also
Sure.
caused an issue, and that is that worthlessness deduction not being available under 165 for virtual currency. Because again, like to your point, we basically have said, that virtual currency is not a security. So,
Hmm.
and 165G describes a deduction for worthlessness for worthless securities. And so, therefore, a worthlessness deduction for virtual currency is currently not possible.
Yeah, it doesn't. It's tricky with respect to that, because there's a lot of there's a lot of guidance out there with respect, or I should say that not a lot, but some guidance that I think you'd mentioned to me that came about in 2009 with respect to Ponzi schemes and things like that. But it doesn't
Yeah.
really the specific safe harbors, for example, that are absolutely not going to work,
Yep.
because that was like the 75%, 95% safe harbor,
Correct.
depending on whether you were seeking recovery or not. But again, because that was all security related.
Right.
There was a revenue ruling that you'd mentioned that deals. it's a little bit different. That might give us some leeway. And this is something that came up on the CPE circuit some this year, talking about that with
Yeah.
respect to the fact that people who have bought this, even though they're not securities, they're not buying this for personal use. They
Right.
are buying the security, or the security is not security, buying the virtual currency for purposes of making a profit, for investment purposes, even though it's not a
Correct.
security. And so that potentially gives us some latitude on being able to take losses potentially, but it's a stretch. To the extent that the thing is not totally worthless, I think we'd agree. Better thing is sell it for whatever amount you can get for it, even though
Yep.
it's a capital loss. At least you've got something coming through on the Schedule D that you
Yeah.
could then use, right? And at least, and I know people say, well, capital loss is 3,000 a year. It's going to take me forever to use it. Yeah, but at least that gives you the ability to rebalance other things potentially
Correct.
without having to recognize those gains. And so there can be some advantage to that. And again, don't let taxes control the economic dog. Don't let the tax
Yeah.
tail wag the economic dog. You got to look at, if you need to rebalance your portfolio, again, having those losses there can make that less painful.
I think that that's well said. I mean, and there is still some ability too. A lot of times when you're doing tax loss harvesting too, sell some winners, sell some losers. One way to kind of avoid a lot of the complexity, to your point, especially when it comes to virtual currency, is to just sell the virtual currency. If you
Yeah.
sell the virtual currency, that's a capital gain or a capital loss, and that one's kind of that one's probably the cleanest of all of
Yep.
these things. So if you're really trying to clients want to, if they want the best way to do it, the cleanest way to do it,
Yep.
sell it. That's it.
Absolutely. Absolutely.
you know let's talk about another place that kind of on the business side
Sure.
that seems to be, I think I described in a class the other day. I described that I said the virtual currency was the problem that wouldn't go away. And then I said that the ERC was the credit that never died. And I compared it to a horror movie, like where the
Yeah.
killer keeps coming back.
Oh, yeah.
And that's where I kind of think that, that's what I personally think of the ERC right now. I think everybody's kind of tired of the ERC. Um, we see some, kind of motions out there that, possibly ending the program, completely. I don't know. I'm, from a practitioner perspective, I would love to just be done, but I don't know if we're just going to be able to cut it off like that. I'm not sure.
Yeah, well, and of course, the quarters that it covered are done. It's just that we're still in the statutory period of when people can file these amended returns to claim it.
Yeah.
And I think the unfortunate thing, well, this, the unfortunate thing is, there are some people out there who don't have the same ethical concerns that the typical CPA or enrolled agent or attorney does, who will just go out there and they'll tell the client, oh, you qualify for this or that or the other thing, even though they don't. Because the thing
Yeah.
is, if this is a client we ran that calculation 3 years ago,
Right.
and we know whether they qualify
Yeah.
or not. And if they didn't qualify, they didn't qualify. And then now you got these companies coming, well, you had the supply disruption, even though you really didn't have a supply disruption. And
Yeah.
and they'll
Yeah.
kind of go with this stuff, and they'll come up with these reasons and they'll file it, and that's why the IRS, what was it, September, that they quit acting on new ones for a while, and
Correct.
they
Yep.
moved it from 90 days to 180 days to act. And I came across people, again, not even personal clients, but came across people I was talking to on the CPE circuit who basically had said, they've had them out there for 11, 12 months, and they're talking
Right.
about legitimate ones, not these
Right.
ERC mill kind of garbage stuff, but the real ones. But the dollar amount's significant enough that the IRS won't pay it,
Yep.
and or at least they're holding it and looking at it. And
Yeah.
so, yeah, it's unfortunate because the legitimate claims get messed up because of all the bad claims that are
That are out there.
out there. And it's not surprising that the IRS has decided to slow this process down and is going to give a difficult look. And I've had a number of people in practice who tell me that they've told their clients, look, if you go out and you file this return that this ERC mill generated for you,
Yep.
then they have to file the amended return to reduce the wages as well. That we're not going to do that. Now, the IRS guidance on that is less clear. That it seems like you don't have quite as high a level of responsibility on that because you're reducing a
Yep.
deduction. But there are a lot of firms that are very serious about this. And when I talk to people, I said I would tell the client, look, you came to me for a reason. You wanted it
Yep.
done right. Yes, you can get a few bucks by filing this claim, but do you really want to be out there if it's not legitimate? But I think part of it is because people think it's just, oh, the government's just throwing away all this free money. And I'm not saying they
Correct.
are. I'm not saying that. I'm going
Correct.
to get into the politics on that. But, a lot of people think they may be they have this free money. The PPP loans were the same way.
Right.
I had one an acquaintance who was talking to me about the fact that they had to refer a couple people over to attorneys because they had taken PPP loans and
Yep.
had used it for personal stuff. And it's
Yeah.
like, good grief. If you, I mean, again, in no way am I encouraging somebody to do anything dishonest. Okay. But if
Right.
you're going to be a criminal, you got to be smart.
Yeah.
You, you know, and it's
Yeah.
like, look, they have the employment tax numbers. I mean,
Yeah.
they then know what you're reporting as wages.
Yeah.
Don't scam money on something that they can match like that in their computer system. This is silly.
Yeah. Yeah.
And you got to wonder what people are thinking. Take a PPP loan, you got to have this percentage of that loan is wages paid. And just,
Yeah.
I get, they just think it's free money. And it's just, good grief.
Well,
It's,
think about it though from the client side though. I think Bill is that I mean you have somebody, and especially I mean we've been in a higher inflationary period over the last couple of years. I mean
yep.
money has gotten tight. I think especially if you're running small
Oh, yeah.
businesses and stuff like that for several, and you have somebody who is in your face. The ERC mills are very aggressive.
Oh, yeah. Yeah.
And they are telling you can get all this government money. It's hard to, I mean, if I'm putting my my hat on as just kind of a small business owner, I don't know. That's hard to resist. I mean, right? It's a lot of money,
Oh,
and they're telling you that I
absolutely.
qualify.
Yeah, absolutely. And I understand that. And, again, they just, this is one that each practitioner is going to have to decide how they feel about dealing with that, with
Yeah.
that client. Are they willing to do that amended business return, not the employment tax one, but the
Right.
amended business return to lower the wages, and even then, do you want to file a protective claim? Are you comfortable filing a
Yeah.
protective claim that says, hey, if you disallow the credit, we want our wages back? And then, are you comfortable with, continuing on with the client in the future? And that's something you just have to think about. Luckily, hopefully the things that are going on with those two won't affect future years.
Yeah.
And then so that you can feel that you're comfortable, moving forward. But the wage calculation being different. Think about an S corp, for example.
Yeah.
You change that wage calculation on an S corp, you lower the wages, that increases your AAA.
Yep. Sure
Increases
does.
basis, increases AAA, and that has a continuing effect moving forward.
Yep.
You know, and
Yep.
so you just have to decide, how you feel about that. And I can't tell people what to do. It's just interesting. That there's just a difference of opinion as to how people feel about that. But here's one good piece of news. If you're
Yeah.
trying to shrink your practice, you know which
Yeah.
clients to get rid of first. The
Yeah,
ones that
yeah.
are,
So
you know,
and I mean, and we're kind of and we're kind of joking, but kind of half not. I mean, like
oh yeah, I'm not.
I mean, one of the things that I think is that I think was interesting this year. As I was out doing tax updates, like you were, is that I had a few people that approached me that were talking about what they said, well, what is my obligation, for signing off on the return? And I said,
Yeah,
you're never compelled to sign off on a return that you don't feel comfortable with. I said, a client walks into your office, they got a 941X.
yeah,
You go through and you ask them, you make reasonable inquiries. That's what we're told to do.
yep,
Circular 230, make reasonable inquiries. and client told you during the pandemic that they were have that business was great, but they got somebody to to give them this 941X. And I just it's interesting to me, the practitioner mindset there, because I got to tell you, I think that's where we need to maybe rethink kind of what we're doing. You never have
Mhm.
to sign off. You
Right.
never have to sign off, and you shouldn't. I mean, if you're not comfortable with something, I mean, it's your name on a line, and
Yep.
this profession, I mean, it's built on integrity. Your name and the credential is everything. And so I don't know. I guess that's one piece where I think maybe we as a profession kind of need to just think about what we're doing there a little bit.
Yeah. Oh, absolutely. I'll tell you a story, and luckily I don't remember the student's name because it's about 20 years ago, so that I can't get in trouble with
Yeah, there you go.
But I had a student actually came to me, and the student said, I think I've got a problem. And this somebody's not a CPA yet, was not working for a CPA, but they came in and said, I think I got a problem. Said, I do taxes. I work for this person, and again, I don't remember the name, luckily. Who they were, and they didn't actually tell me the name, so that there's no way I could remember it. But they said they work for a person who's not a CPA, but they require all the staff to get their own PTIN numbers, and the staff signs the returns themselves. But then she makes us claim certain things even if they're not there. And I said, yeah, it sounds like you do have a problem, and you probably need to find new employment, because
Yeah, yeah,
again, they were apparently, my take from the person is that this was one of the credit mills. Remember, we used to have the earned income credit, issues and things like that, where somebody was promising clients, refund amounts, but she was not signing on the return herself. She was making her people sign. Say, no, don't ever sign anything that you don't agree with. It's not worth your future, license to do that. And people will try to do all kinds of. Some people will
yeah.
do all kinds of things to try and get, make a buck if somebody else is going to be the one who takes the fall.
Yeah.
You
And
know.
yeah, and I mean, and on all honesty too, I mean, how much are you charging for that return too? So you're really to put your license and
Yeah.
your reputation and possibly the future of your career. I mean, I guess depending on how egregious it is, but I mean, like I think that that's the part where I think we got to get maybe be a little bit smarter as a profession. Just what do you make it? A few bucks on a return, for amending an 1120 or an 1120S or something. I mean, come on now. I mean, it just feels like we need to be a little bit better there.
Yeah, and I hope you don't mind. I'm going to change topics on these slightly, but
Yeah,
on some, it's a very interesting dynamic in practice that I have never seen before.
yeah,
Maybe it's happened before, but I haven't seen before. I was talking with a friend in Oregon who's again, letting clients go because for some reason it seems like there's a shortage of accountants out there who will take on new clients,
yep.
and people come in and they'll pay more money, the fees, and of course this particular person I was talking to feels guilty about raising the fees on his pre-existing clients, but has other people who come in and they'll it's just an interesting world, because it used to always be you were always having to be, and probably for the big firms they still do have to be aggressive about the in terms of courting the large audit clients, but for those of us in like small and middle-sized practice, it seems like a different world, than I've ever seen. Because I just can't remember other than people like in my case, I'm phasing down, and so I am doing less and less. I mean, I want to keep enough clients to be able to have interesting stories for my students and for talks like this, and
Yeah,
for the CPE I teach and stuff. But I just I'm not trying to make I'm not trying to grow a practice.
right.
But it's really interesting. But I've not seen this situation just in general practice like this in the
I
30 years. So
I don't think that you're off base there, though, Bill. I mean, I really don't. I mean, because I do think that there is something to, especially now. I mean, you do have a little bit of a shortage of CPAs. I mean, we've heard about it.
yeah,
I don't think I'm out of bounds in saying that. Um, and so because of that, I feel like on some level you can kind of let clients walk. I mean, so I mean, if
yeah,
somebody is really pushing you on something that you are not comfortable with, what are we hanging them onto them for? I mean, because they need you, and the thing is that like I think that sometimes we're in this mindset that it's like, well, I got to make sure that I protect the client base that I got. And sometimes it's it's that old adage where it's like, 20% of your clients create 80% of your problems or
Yeah.
whatever that
Yeah.
is. Okay. And
Yeah.
so like I always think about that. It's like, if you get rid of your problem clients, you probably are leaving room for you to take on a whole lot more good ones,
Yeah. Absolutely.
you know.
Absolutely. Yeah.
Let's talk about another area that I think is that I think a lot of firms are struggling with what to do on, and that's this beneficial ownership information reporting from FinCEN. This continues to be a difficult one because you got FinCEN that's kind of said,
Mhm.
"Hey, we don't care. Just file the form. We don't care if the attorney does it. We don't care if the accountant does it. We just want the
Mhm.
form filed." But I
Yeah.
think a lot of practitioners, and I think probably you and me included, are concerned with the unauthorized practice of law and kind of how that how that corresponds to everything. Because we should mention that this unauthorized practice of law is not consistent across all the states.
Correct.
It's not like you can use that term and it means the same thing everywhere. And so I think that's part of the
Right.
complexity. But I think it also, I think, and rightly so. I mean, I think we as CPAs are kind of like, well, should we really be doing this?
Yeah, and that concern has been brought up a lot by professionals by
Yeah,
CPAs, this year as to whether or not it is something that would be, crossing over into the practice of law. And the other concern that comes up similarly to that is whether or not it's something that they're creating a big liability risk by doing if for example, the information wasn't accurate or something was to come through. So I've heard both those concerns, the crossing of practice of law and, what is the malpractice risk. And so, yeah, I think a lot of us were hoping that the state bars would come out
yeah,
and put out something about this. But, of course, why would they ever, you have to wonder, why would they ever say, oh, no, that's not practice of law. You go ahead and do it. I think,
yeah.
no, because think about
Good
this. They kind
point.
of learned their lesson 100 years ago. Remember when the tax rules first came out,
Yeah,
attorneys could have had all of that work that we now do as accounting tax because it is the law.
right,
They didn't
right,
want it. They didn't want it. It was beneath them to do
right,
that. And
right.
so, accountants sort of filled that void. And of course, now you do have tax attorneys and tax accountants who both do this work. And I think we'd agree that by and large, when we work together, we get the best outcome, right,
For
for
sure,
clients and things like
for
that.
sure.
But it's interesting there, that it wasn't clear when the tax law was first passed. Now, obviously, I was not born then, but I can read history, as to how that would have, played out. And now here with this, there I don't expect them to say, well, this is not the practice law. The question is, would any of them come in and actually, try to say that it is the unauthorized practice of law? Would somebody do that? Um, I don't know that any firms, that any attorneys firms would actually try to bring an action or anything, but it is a concern. So I'm gonna give you the
Yeah,
long answer, but it is a concern, and it's something that people have to think about. They have to think about this. I for sure, if I were going to this, and by the way, I'm not going to do this for anybody.
right.
That's just
Me
I'm not
neither,
telling
by the way.
anybody else. Oh, okay. Yeah, I'm not telling
Yeah,
anybody else they shouldn't, but I'm not going to do this. But if I were, I would for sure talk to my firm's attorney
yep,
and to my practice carrier first.
yep.
Just because me, I'm a nervous person about all this stuff. It's you're not paranoid. If everybody really is out to get you, right? And
Yeah.
so you just have to kind of be. I just tend to be nervous about these things, and so I would definitely check with those. With those two before.
I think that's well said, Bill. I mean, so I'm not planning on doing it for any of my clients either. I mean, full disclosure. I mean, and we have had some of the larger regional accounting firms that have come out and said, very similar things. I have run into a few firms that have said, hey, we're going to do this because we feel
Yeah.
like we're on solid ground. I think your points, though, I think are good ones. I definitely would echo the one on your professional liability insurance company. I think having a conversation there before you make a decision, I think that one's pretty important because if you do happen to get a claim, you want to make sure that it's covered. The other thing is too is that having a separate engagement letter, I think, is
Oh,
also
absolutely.
because it's not tax prep. And it's not tax consulting,
No.
so it's a whole different thing. And so if you do think that this is okay after you've talked to the people that you need to talk to, counsel, and then also your professional liability insurance company, I mean, I think at the very least you want a separate engagement letter, or if you did decide to go down that road, because again, the risk is just very different.
Yeah, I would agree with you fully on that. Have an engagement and make sure that the client knows they have responsibility for telling you when there are changes, because it's what, a 30-day requirement
Yeah,
to notify of changes once it starts, and that make sure the client knows you're responsible for that. That's a separate engagement. You got to come back to me and tell me if there are changes. Yeah. So, and hopefully, the malpractice carriers will start developing sample language that can go into our engagement letters. But yeah, engagement letters are incredibly important.
yeah, yeah. So I think if you're out there and you really are struggling with this, I mean, so I think that's maybe a spot to maybe look to first to kind of help you make that decision. But I think a lot of
Mhm.
practitioners, I think, continue to struggle there. So,
Oh
well,
yeah.
I have to tell you, Bill, I've had some people say it's a light tax year in 2023. I don't know, man. I mean,
Yeah.
especially after all the stuff that you and I have just talked about. Sure seems like there's a lot going on. Any closing thoughts as practitioners are kind of working their way into this tax year? Any words of wisdom or advice, or any just well wishes or thoughts?
Well, just I guess maybe this is on my mind because my wife and I we were able to adopt our foster son this year, and that's a year that we just had to go out and do all the changes to our documents and things like that. And so I would tell you, as you meet with your clients, find out if they've had any life changes. Talk to them about some of these non-tax, more financial planning things like, did you go see the attorney and update your wills? Did you update, this, that, or the other thing? Because sometimes people let these things sit for a long time. And, as
Yeah,
the tax person, you are really the best person to truly help your clients with a lot of their financial planning stuff. Maybe not,
yeah,
again, I'm not saying picking stocks, but the holistic kind of things, because you see them every year.
yep,
And
yep,
so, and I like to actually sit down with people and talk to them a little bit, and about just what they have going on.
yeah,
And again, it's a good time to remind clients of those types of things. And again, I know that's not a technical tax matter, but it's something where you
yeah.
can really add a lot of value beyond just the dollars and cents on a tax return.
Yeah, and I think that what Bill said, I think is spot on, folks. I mean, don't forget. I mean, if you are a tax practitioner out there, you serve a lot of good out there, and you can really do some great things. And your work is extremely important. And even though it may not necessarily always feel like that, especially around April 14th or so, but hang in there, folks, because you are doing great work, and so we appreciate all of the good practitioners that are out there. So anyway, but
Yeah, absolutely.
with that, folks. Bill, if folks would like to get a hold of you, is there a way for them to do that?
Yeah, I can give my practice email. It's going to be long.
Yep.
It's James William Harden with an E, not an I. Yes, like the basketball player, but with the William in the middle. But James William Harden, CPACHFC at gmail.com. So again, James William Harden, CPACHFC at gmail.com.
So there you go, folks. So hopefully it's a great tax season for you. Hopefully we've at least given you some things to chew on here. So
Yeah.
Bill, thank you so much for joining me here on Accountable. It was great. Thanks so much.
Thanks, Dave. Great talking to you.